free cash flow. In corporate finance, free cash flow, FCF, or free cash flow to firm, FCFF, is a way of looking at a business's cash flow to see what is available for distribution among all the securities holders of a corporate entity. This may be useful to parties such as equity holders, debt holders, preferred stockholders, and convertible security holders when they want to see how much cash can be extracted from the company without causing issues to its operations. Free cash flow can be calculated in various ways, depending on audience and available data. A common measure is to take the earnings before interest and taxes multiplied by 1 minus tax rate, add depreciation and amortization, and then subtract changes in working capital and capital expenditure. Depending on the audience, a number of refinements and adjustments may also be made to try to eliminate distortions. Free cash flow may be different from net income, as free cash flow takes into account the purchase of capital goods and changes in working capital. Calculations. Free cash flow can be calculated as follows. Note that the first three lines above are calculated on the standard statement of cash flows. When net profit and tax rate applicable are given, you can also calculate it by taking where. When pattern debt/equity ratio is available. Where D is the debt/equity ratio. For example, for a 3-to-4 mix it will be 3/7. Therefore, difference with net income. There are two differences between net income and free cash flow. The first is the accounting for the purchase of capital goods. Net income deducts depreciation, while the free cash flow measure uses last period's net capital purchases. The second difference is that the free cash flow measurement makes adjustments for changes in net working capital, where the net income approach does not. Typically, in a growing company with a 30-day collection period for receivables, a 30-day payment period for purchases, and a weekly payroll, it will require more working capital to finance the labor and profit components embedded in the growing receivables balance. When a company has negative sales growth, it's likely to lower its capital spending. Receivables, provided they are being timely collected, will also ratchet down. All this deceleration will show up as additions to free cash flow. However, over the long term, decelerating sales trends will eventually catch up. Net free cash flow definition should also allow for cash available to pay off the company's short-term debt. It should also take into account any dividends that the company means to pay. Net free cash flow equals operation cash flow, capital expenses to keep current level of operation, dividends, current portion of long-term debt, depreciation. Here CapEx definition should not include additional investment on new equipment. However, maintenance cost can be added. Dividends, this will be base dividend that the company intends to distribute to its shareholders. Current portion of limited, this will be minimum debt that the company needs to pay in order to not default. Depreciation, this should be taken out since this will account for future investment for replacing the current PPE. If the net income category includes the income from discontinued operation and extraordinary income, make sure it is not part of free cash flow. Net of all the above give free cash available to be reinvested in operations without having to take more debt. Alternative formula. FCF measures. In symbols. Where investment is simply the net increase, decrease, in the firm's capital, from the end of one period to the end of the next period. Where KT represents the firm's invested capital at the end of period T. Increases in non-cash current assets may, or may not be deducted, depending on whether they are considered to be maintaining the status quo, or to be investments for growth. Unlevered free cash flow, i.e., cash flows before interest payments, is defined as EBITDA, CapEx, changes in net working capital, taxes. This is the generally accepted definition. If there are mandatory repayments of debt, then some analysts utilize levered free cash flow, which is the same formula above, but less interest and mandatory principal repayments. The unlevered cash flow, UFCF, is usually used as the industry norm, because it allows for easier comparison of different companies' cash flows. It is also preferred over the levered cash flow when conducting analyses to test the impact of different capital structures on the company. Investment bankers compute free cash flow using the following formulae. FCFF equals after-tax operating income plus non-cash charges, such as D&A, CapEx, working capital expenditures equals free cash flow to firm, FCFF. FCF equals net income plus non-cash charges, such as D&A, CapEx, change in non-cash working capital plus net borrowing equals free cash flow to equity, FCFE. Or simply, FCF equals FCFF plus net borrowing, interest, 1T. Uses. Problems with capital expenditures. Agency costs. In a 1986 paper in the American Economic Review, Michael Jensen noted that free cash flows allowed firms' managers to finance projects earning low returns which, therefore, might not be funded by the equity or bond markets. Examining the U.S. oil industry, which had earned substantial free cash flows in the 1970s and the early 1980s, he wrote that. Jensen also noted a negative correlation between exploration announcements and the market valuation of these firms, the opposite effect to research announcements in other industries.